Welcome to the Daily Brief, where I'll go over the action in the market for Monday, January 23rd, and then we'll see how things look for Tuesday, January 24th. And one thing right off the bat is that we saw an up day on Friday, and that was options expiration. What quite often happens is when we have an up Friday, the Monday will end up being down. Well, we didn't see that. We saw some strength in Friday's session, only to have it follow through on Monday and have a pretty good session. There was some weakness during the day in Monday's session that I'll go through and talk about, but for the most part, it was pretty solid. Things have shifted back positive now. Our trend, although it's still way below 20, is starting to turn back up and getting a little bit stronger. We're above that trend line that I've been talking about over and over. It's not very far in the rear view mirror yet, so we could always come back down, and I'll go through and show you the charts of these things. So let's go back and talk about what happened. Right at the open, we had a higher open. There wasn't a really big gap, but there was a positive bias going into the open. Prices quickly climbed above R1 at $39.98, so we're dealing with that 4,000 level. And then almost right after that, shot up to R2 at $4,023. As the day went on, prices were above and below R2. We kind of stalled out there. There was an attempt to break out higher. Prices shot up, but once that exhausted itself, selling took prices back down, and that's the weakness that came out later in the day. We got almost back down to R1. When we hit that level, buying resumed with prices reaching back up to R2, and then going into the close, we were just a little below R2. So we were up 1.19%. Volume was back to being above average. The technicals have pretty much switched positive now, and we even have some overbought indications to look at. Not really surprising. That's what happens when we're in a sideways, trendless environment. We get some strong up or down days, and we go extreme positive or negative very quickly. Everybody is still focused on inflation and interest rates, which are producing growth concerns both inside the U.S. and outside. This is funneling through into the earnings per share, or EPS, as well as valuation concerns for the stock market as a whole. Earnings were just starting to come into the big part of earnings season, and so this can have a real influence on the market where you have some big names coming out with their earnings. If they're taken well, that could give some support. If they're not taken well, that could give some real resistance going forward. And then any Fed speak that we get. There's none scheduled as far as formally scheduled speeches. If we do get any Fed speak, it'll be through an interview or an article or something like that. Here is the intraday chart showing that we had a higher open. We were above the unchanged level the whole day. We never did drop down below it. We quickly went up through R1 and then immediately shot up to R2, broke through that. This is where things started to stall out. Once that took a breather, we tried to go up a little bit higher, but then we topped out just under the 4,040 level before coming back down. And this is the weakness that we saw, and it's like, oh boy, what's going to happen here? Well, that exhausted itself as well. We almost got back down to R1 before coming back up, hitting R2, going into the close, and then closing just a little bit before that. It was a pretty positive day. What are some comments that we can make? One thing I want to mention is the SPY, which is the ETF for the S&P 500. It's now 30 years old. Back in 1993 was when it was first created. This is about the time that I started in the markets myself. When it first came out, I was aware of it, but it was so new, I wanted to give it a chance to really test itself. Well, now you look at the whole ETF universe and the massive amounts of volume and the massive interest that this has caused in the market, and it's really helped to make the market be a lot more efficient. And it all started with the SPY, which we call the spiders. The SPY is the ticker symbol. The actual acronym is SPDRS. One question that we need to ask after Monday's session, we saw a strong Friday and now a strong Monday. Is this a pump and dump rally? We've got a lot of earnings coming out. We're above that trend line. We could easily go back down below that trend line. We want to keep an eye on this because the VIX is still very low, and I'll show you a chart of that. When the VIX is low, it's time to go. The equity pull call ratio is still pretty high. However, we're in a little bit of an overbought condition, so that could be negative. And then you have folks pretty much thinking the market's going to go down from here. Sometimes that's a self-fulfilling prophecy. Other times it turns out to do the opposite. In Monday's session, the NASDAQ and the NASDAQ 100, they performed pretty well. They were the leaders, and that's what we need to see on a consistent basis if the market is really going to get some legs and move higher. The tech sector, which just got hammered in 2022, as well as semiconductors, and I have a chart of the semis to show you, they were up pretty strong. In the weekend video that I did, I talked about how semiconductors are getting ready to potentially give us a golden cross. We've got Intel coming out this week with earnings. We've got a lot of things happening. There was a lot of buzz over the weekend. Look at the strength in semiconductors. Look at the strength in technology. Maybe we need to start getting back into this. It's so beaten down. Now's the time to possibly jump back in. That's some of the talk that's going on. Also in Monday's session, communication and discretionary were strong, and then energy was weak, which is kind of the opposite of pretty much the whole story in 2022. Growth outperformed value, at least in the large caps. One little warning sign that I'm seeing, and I have a little screenshot to show you, the small and mid cap growth, they underperformed. Their value ended up doing better in Monday's session, where the large caps, the growth did much better. The S&P is above the trend line. Can it stay above that level? It's not very far behind us. Can we continue to go ahead of this? Because we've come up through this trend line before only to fall back down. Then we also have to ask another question that I've been really trying to keep an eye on. Will the U.S. economy achieve a soft landing? What is a soft landing? Basically, it's when the Fed is raising interest rates and then they start to lower them without the economy going into a recession. That's a soft landing, and that's the goal of the Fed. It's almost impossible to do that. As I've mentioned before, it may have happened back around 1994. I'd been only doing this for about a year or so at that time, and was kind of new to all of this. If I recall correctly, I think it happened then. Another thing that happened is there's a Wall Street Journal article, and the market's been burned by this before. An article written by this same person. It was published over the weekend by Nick Timiraos. I don't know if I'm saying that right. He's suggesting that the Fed may pause its rate hikes this spring. Be careful of this. The idea is that this particular reporter is kind of palsy with the Fed, and sometimes when they want to float something to the market, they'll contact this person and have him do like a plant in the story. Have him write something about it, see how the market reacts to it, and then it's like, okay, now we know how the market's going to behave if we actually go forward with this idea. That was what was really buzzing the last time this type of a thing happened. So we don't really know, because when it's happened in 2022, the markets got all ready for a pivot only to have the rug pulled out from underneath them, and then everything started to decline very quickly. So we need to be careful of this. We need to be aware that it's happening and that it could be positive, but at the same time, once bitten, twice shy. Some of the strength that we saw in Monday's session is when you have everybody pretty much convinced that the market's going to go down, that's when it starts to go up. And so a lot of people that have short positions, they had to start covering, and that just helps prices go up and up and up because they have to buy to exit their positions. Microsoft and Tesla are coming out with their earnings this week. Are they going to do a pump and dump before the earnings report where they bring the price up and then the news comes out and then everything just falls after that? More of a buy the rumor, sell the news kind of a thing. Not saying that that's what will happen. It has happened before, and we just want to be aware of that. Also, on a short-term basis, the usual suspects, our Stochh RSI and our Williams percent R, they are extreme positive. On an intermediate-term basis, we have the CCI 14 and 20. A lot of times when I use these indicators, the CCI just barely goes up and barely goes down. Well, when we're in a trendless environment like we've been in, a lot of our oscillators can really pick up and move a lot more drastically. And that's what's been happening with the CCI. And then even on a long-term basis, we have our moving average study, and I have all the charts here to show you these different readings. The dollar was up slightly, and interest rates were also up. Copper is still hanging on to its gains. We're just keeping an eye on that because that's Dr. Copper. It's looking out into the future, and it's predicting that things are going to get better. We still have our yield curves that are inverted, with the 10 to the 3-month being the most inverted. Sentiment is still positive. We're in the 65 range. We're not extreme currently. The economic report that came out on Monday was the LEI, the leading economic index, and it was down 1%. That was weaker than the expected, down 0.7%. The last time we had this report, it was down 1.1%. So looking out into the future, leading economic indicator, it's predicting a slowdown. And there's some economists that are really picking up on this. There's a chart that I'll show you here in just a moment that talks about this particular report. Our trend is still positive. The green line's on top, and it's starting to turn back up, so it's going above the moving average, but we're still below 20. The bias I've switched to positive because you had the Friday and the Monday up days, and our momentum I've also switched back to positive. Even though we were negative last week, we're now starting to come into a much more positive phase. This could change at any time, but based on how things look right now, things are turning much more positive. One headline that I saw, and we're keeping an eye on the situation in Japan. This was in Reuters, but if you do a quick Google search, this article is likely to come up in many different places. Japan warns of dire finances as the Bank of Japan struggles to contain yields. There's some real problems developing in Japan. I've been talking about it for a few months now. It hasn't really come to the forefront. It hasn't really led to a contagion where it bleeds over into the U.S. market, but it could at some point, so we just want to be aware of this right now. It's problems developing in their bond market where for a long time they've had next to zero interest rates there, kind of like what we had in the U.S., and now that they're starting to see some inflation in Japan, it's causing some problems because their interest rates are going up, and now they're having to borrow money to buy more bonds at a higher interest rate, and that's kind of messing up their whole game plan. And that could eventually feed over into the U.S. market because Japan owns an awful lot of U.S. bonds. And if they have to start selling those bonds, when you sell, that pushes prices down and interest rates up, and that could affect the U.S. economy. Another thing, this is when I talked about value and growth. With the large caps, growth did well. It was up 1.28%. Value was up 1.19%. Okay, so growth outperformed. But when you look at the mid caps and small caps, you see that value outperformed growth. Value outperformed growth. Just a little thing to be aware of. These are the things that I look at every day. We just take note of this, keep it tucked back in our mind, just to know that when things start to happen, we're not caught off guard. Another thing is, this is that same gentleman that writes articles for the Wall Street Journal. This is the article that he posted. And this is the tweet that went along with that article. If you subscribe to the Wall Street Journal, please feel free to check it out. There may be some reprints elsewhere online. This was a tweet that came out on the 23rd, which was Monday, and it was by Michael J. Kramer. And here's a chart showing the LEI, that's the leading economic index, the economic report that came out in Monday's session. It declined more than expected. The LEI on a year-over-year basis seems to track the year-over-year S&P 500 earnings growth. The LEI is the white line. And that's the report that came out in Monday's session. The yellow line is the year-over-year earnings growth, and earnings growth has been going down, and these two tend to track each other, going back all the way into the 90s. It's a little spotty data over here. Lately, it seems like, we can kind of go along with that. So that's why we're paying more attention to the LEI. Looking at the VIX to S&P 500 correlation, we're coming off of this spike that we saw, and it's starting to drop. It's still continuing to drop. That could be giving some support to stocks. Another thing that we're looking at is the Ulcer Index. This attempts to measure fear. When it's below the moving average, that means that we're pretty complacent. We're kind of getting a little less fearful with our sentiment reading, and so that's pretty much matching up with what we're seeing now. If we start to fall, this line will continue to go up, hence the name Ulcer Index. Here's the equity put call ratio on the daily chart showing how it declined in Monday's session. Here's the 5 period where it was starting to bounce up when we hit some trouble last week. Well, now it's beginning to roll over. Here's a longer term look at that same chart where we really spiked up and we're starting to come down. We're still at a pretty high reading, but if this continues to fall, that could give some support to the S&P 500. Here's the VIX showing that we're very low when we're measuring using this. As far as fear is concerned, we're on a closing basis, we're now back below 20. Here's the bar chart. It was a really small range for the day. To have a big up day like we saw and to have the VIX be in a small range, that's why we're focusing more on the equity put call ratio right now. This is suggesting that there's a lot of complacency in the market. where this is suggesting that there's a lot of fear in the market. So we're getting some contradictory signals right now. Here's a VIX of the VIX where it came down because the VIX ended up declining, so volatility of the VIX is declining slightly. Here's our trend where we're just coming back above the moving average. So that's strengthening now, but we're still below 20. The green line's on top and advancing. The red line's on bottom and declining. So this is looking better, at least right now. Here's our daily chart where we came up through the trend line. And don't try to take the trend line that I have on here as gospel. I hand draw this, and I could easily be wrong. I'm trying to hit the top up here, the top up here, the top down here. This is the part where we sliced through this, but we didn't close above this trend line back in December, and then we really declined after that. Well, now we've come back up through this trend line, and we were able to close above the trend line. That's positive signal number one. We're above the 50. We're above the 200. We came right up to this pivot level at R1. That was the high for the day, and then that's when we started to come back down. That was the exhaustion that we saw in the intraday chart. Well, if we can stay above this trend line and then either go sideways or start to move up from here, we have lots of other resistance above where we're at, but at least we could break this downward sloping trend line. That would be quite positive for the market. And then down on the bottom, we see where volume did drop from Friday's session, but it's still above average. Here's the stochastics in the short term. Not surprising. In the short term, extreme positive. Not there yet with the intermediate or longer term stochastic. Here's our Stoch RSI, extreme positive, and Williams percent R, extreme positive. Doesn't mean we have to stop. It just means that we're going up pretty fast here, at least in the short term. Bullish percent index, showing a bit of an advance. We're above 50 and going up, so that is positive, and we're not extreme with this indicator yet. The CCI 14 and 20 are starting to get extreme positive. That's more intermediate term. Chicken money flow actually declined a little bit from Friday's session. Kind of interesting, but it's still positive overall and trending higher. Short term, we broke through this 4,006 level on our short-term fib chart, which goes from the August high to the October low. The next level up here is from the September high to the October low. That would be the blue line at about 41.23, but we've got a ways to go to get to that. Can we stay above this? If we start to fall, we'll be looking at one level is the 4,006 level. Here's a longer term look where we came up to this longer term fib retracement at 40.20. We actually broke above that a little bit. We hit a high of almost 40.40. And again, these are lines that I draw myself, so there's nothing necessarily sacred. And the thickness of the line, because these charts are longer term, there can be 20, 30 points just in the thickness of a line. Can we break above this resistance? We've done it before. Can we do it again and then stay above it? I just wanted to show you all of our oscillators. After showing some weakness last week, they're starting to roll back more positive. Swinland Trading Oscillator gave us a little warning signal after Friday's session. It still declined. Well, it's starting to turn back up based on price and volume. However, it's below zero, both above and below, so that is slightly negative. We're breaking out of the upside of the moving average tree where we were able to get above and then close above the 200-day moving averages, and all the other shorter-term moving averages are behind. If we can stay above this, that will help our tree to look much better and possibly even make it so that our rainbow charts are even useful to look at. The Elder Impulse on the S&P 500, we switched back to positive after Friday's session, still showing a green bar after Monday's session. Summation index based on price and volume are advancing, and both are above zero. I added some things to this chart here. This is the double and triple exponential moving average, and this is 50 periods. And we have the blue line is the double, and the red line is the triple. I had the anchored moving average going back to the COVID low. Well, I added a lighter blue anchored moving average going back to the all-time high. I measure the all-time high from January 4th. We actually hit our closing high on January 3rd. I wanted to measure it from the intraday high, which was the next day. It's interesting when you look at this blue line how this has acted as resistance, especially lately as we get further along in this. This could be another level of resistance, and it's at about the 4,085 level. New highs, new lows, needing a little bit more because this area where we're in, we were at back in November and into early December. These measure 52-week highs, and we haven't gone 52 weeks yet. So we need to break above this 4,100 level to really see a breakout in new highs. It is turning back up slightly because we had an up day, but it's still below the 5-period moving average, and we're still declining with the 10-period moving average. The advanced decline line showing improvement based on price and above the moving average, and we're back above a declining moving average right now. Can we stay above that and see the moving average start to turn back up? The Copic curve still gave us a buy signal back in early January that we're working off of. Praying bottom fisher also gave us a buy signal at about that same time. These still appear to be valid. Here's the longer term moving average study. The 50 period, that's in other studies. When I say long term, I'm talking about the 150 and 200. We're starting to get a little extreme positive with the 150 again, but we're seeing an advance with the 200. The Dow, giving us a recent golden cross, was able to come back above the pivot and regain its 50-period moving average. The Elder Impulse system for the diamonds, which is the ETF based on the Dow, it switched back to a green bar. When Goldman Sachs came out with their earnings last week, that put the Dow under a lot of pressure. And even on days when the S&P was doing better, the Dow was still under a lot of pressure. Well, it saw a pretty good up day. It was up over 1% on Friday, and it was up 0.75% on Monday. Here's the QQQs, which are the ETF attached to the NASDAQ 100. They also switched to positive after Friday, and they continue to be positive, and we're up 2.22%. Really strong day for the NASDAQ and NASDAQ 100. We need to see this continue, not just be a 1 or 2 day thing. The mid caps, after giving a recent golden cross, were able to get above this R1. We closed right at this R1 level on Friday. We were up 1.25% and saw a pretty nice gain. Here are the home builders. We're seeing a little bit of a negative divergence. We're starting to break out a little bit with the S&P 500. We're not breaking out necessarily with the home builders. This is just looking at the ETF itself. Then down here, here's the ratio between home builders and the S&P 500. It did turn up slightly, but is not breaking out yet. And if we look at the very bottom, we see where this relationship, where they had been going pretty strongly in the same direction, well, in Monday's session, that relationship could be breaking down. This is something we just want to keep an eye on. If this builds on itself, if we see the S&P go up while home builders continue to go down, that's going to raise bigger and bigger warning flags. Semiconductors, I wanted to bring this up. We were up over 5%, my goodness, in one day. Getting ready for what could be a golden cross here. And I pointed this out over the weekend in the inter-market analysis video. I usually don't show this chart very often, but because we're getting close to a golden cross, because the semiconductors are a huge part of technology, this could be a significant event. Emerging markets also started to hear little rumbles about this. I noticed this late last week where we're seeing some strength in emerging markets. Those are markets outside of the U.S. When you see the dollar really starting to weaken and things starting to recover in other markets, people want to shift their money to overseas or outside of the U.S. type of investments. We're starting to see some improvement here. We were up 0.72% in Monday's session and getting ready to show what could be a golden cross. It's probably going to happen unless we just see a real significant downturn. Looking at a few of our possible positive scenario charts, the small cap index, after coming down to the 50-period moving average last week, has now bounced nicely off of that and regained this R1 pivot level. The small caps actually underperformed, as I pointed out at the beginning of the video, but we're still in an overall uptrend. This is just something to be aware of. If the S&P is going up and small caps continue to underperform, as well as mid caps, that's a warning sign we want to be aware of. Then here's the ratio. The red line, the small cap ratio to the S&P 500, it ticked down slightly, but we are showing some recent strength. That could give some support to the blue line, which is the S&P 500. Staples, this is looking pretty good. Now, it's looked really good before, only to stab us in the back. So just something to be aware of here. This spike that we set right at the end of December, and we've been falling ever since then, This could really give some support to price. Are we going to see follow through with price action? Doesn't mean we go straight up from here, but if this plays out the way it has at other times, this could be a significant signal for the S&P 500. What's our outlook for Tuesday? The major economic reports that are coming out this week, and usually I just go the next day, but these are kind of big. We have advanced GDP coming out on Thursday, and that'll be for the fourth quarter. And we also have personal income and spending. That's a huge report that'll be coming out on Friday. Just be aware of that ahead of time. The technicals, I'm pretty much switching over to positive now, and we're slightly above that long-term resistance. Positive in the sense that we're going up. That resistance, we're above it right now. Can we stay above that level? The economic reports coming out on Tuesday. We have the preliminary IHS Market Manufacturing PMI. Geopolitical events not really playing into the overall equation, but that could change anytime. The market's still really fixated on inflation and interest rates, growth concerns, earnings per share, valuation, and then the earnings as they're released by companies. Then looking at the Stock Traders Almanac, how does Tuesday the 24th look? Not very good for the Dow. It's neutral to negative, being up 42.9% of the time. The S&P is a little bit better. It's slightly over 50 at 52.4, so it's neutral to positive. The Nasdaq, though, looks better. It's been up 66.7% of the time, and that should be neutral to positive instead of negative on there. I forgot to change that one. And then the other areas that I consistently talk about, I'm just going to scroll through these. I've talked about some other areas, and I don't want to have this video be too long. But please feel free to check out some of the other videos, and I do go deeper into this from time to time. Our scenarios for Tuesday, not going with the down one, because we're basically positive now, but we're not too far above the trend line. That could ruin the party here. That could rain on our parade, so we just want to be aware of that. Can't really go with the up one yet. Yes, we're turning more positive. We may be breaking out, but we're not trending yet unless you're super aggressive and you want to take that ADX and you see it going above the moving average and you want to go ahead and jump in now. Nothing says you can't, and you might very well be right, but you also have to prepare yourself if you're wrong and you're doing a trend-based system and you hope that the market's going to go up and you come down. You better set your stops or have your limit for how much you're going to lose if we start to go back down below that trend line. So we're still on an official basis going more sideways. Even though the ADX is strengthening, we're still below 20. The green line's on top, so we are positive. Our conclusion, the S&P is positive, and I say either and above resistance or but above resistance, either positive or negative. I just want to get further away from that line. It's been such an albatross around the market's neck that it would be nice to leave that thing in the dust. Short term, we're positive, but we're becoming short term overbought. Intermediate term, slightly overbought with those CCI charts that I showed you. And we're positive again with the long term because we're above the 200-day simple moving average. Thank you. I hope this was valuable to you. I hope you have a great day. I'll keep a close eye on things and look to talk to you in the next video.